to everybody, and thank you very much to the organizer for giving me the opportunity to be part of this important event. I'm very honored to talk to you about the European Union views on the fiscal policy that should be taken, and especially that European Union member states should take in 2023 and beyond to ensure fiscal sustainability, but also to support growth in these difficult circumstances. I've been working on the surveillance of public finances of European Union member states for many years now, and we have built a network which I believe is similar to yours. We meet regularly among administrators, officials who work on public finances in the different national and institutions and in the European Union to discuss about fiscal policy development and how to approach the fiscal surveillance. But that's the usual practice to meet inside the European Union, but now I'm here and I'm especially happy to have this opportunity to exchange views with representative and official of other countries, of other regions of the world. Having seen the intervention of executive directors of Asian countries in the board of the International Monetary Fund, I've seen how wise they are and understood that we have a lot to learn from you. So very happy to be here. Before talking about fiscal sustainability, let me tell you that the European Union, the 27 member states of the European Union, have of course a national fiscal framework, have their own fiscal framework, but they also have to comply with the European Union common fiscal framework, which envisage benchmarks and rules that apply to all member states. And the reason is especially that among the member states that share the same currency, the euro, the monetary policy is common, but national fiscal policies remain different. National member state can choose them. So there's a particular need for coordinating and respecting rules to avoid negative spillovers like we experienced already in the past with the euro area crisis. But let me now illustrate a bit the problem we face in the European Union. You can see from this graph that uses some data of the International Monetary Fund that our debt ratio is quite high, the average debt ratio. In reality, the debt ratio of the member states are quite different, but this is another issue. But on average, they are quite high, and they have been increasing recently. Particularly, they increased in 2007, following 2007, because of the great economic and financial crisis, and they have not declined a lot, at least after that crisis, and especially the euro area crisis of 2012. But they were starting declining when the COVID-19 pandemic hit, and many fiscal measures had to be taken to support the economy. during the year of the confinement especially. Then, according to this projection, that ratio slowly decreasing in the following year, but now we have to see also what will happen with the Russian war of aggression against Ukraine, which is still ongoing, unfortunately. And so let me now, sorry, just to say that, however, I see that here the projection of for emerging and developing Asia of the International Monetary Fund, see the debt ratio increasing a lot, also on average for emerging and developing Asia. So indeed a common problem we are facing now, that of ensuring fiscal sustainability. Let me focus now on the analysis of that sustainability in the European Union. Specifically, I want to show with this slide, I would like to show that many institutions, international institutions, but also national institutions, carry out analysis on the debt sustainability of the EU member states, European Union member states. So this is indeed an aspect that is monitored carefully in the European Union. There are European Union institutions like the European Commission, for which I work, the European Central Bank, but there are also international institutions, and interestingly, there are national independent fiscal institutions that have been developed after the great economic and financial crisis in all member states, and now the 1/3 of them also carry out, according to their mandate, that sustainability analysis for their countries, and others do it on their own initiative. So this graph simply is meant to show to you that many EU countries, also national independent institutions, carry out that sustainability analysis. And why? In reality, why is so developed the sustainability analysis in the European Union is not just because of the high debt ratio that I've seen before, but because since many years, actually it's a long time that we are unfortunately aware of it, the debt projection for the long term are also going to increase significantly, and this is due to our demographics, in particular aging population, where we started earlier maybe than other countries having this kind of issues with pensions development in particular, but also healthcare development in healthcare expenditure. That some member states have already taken measures, pension reforms, to reduce this, to curb a bit pension development in the future, but some of them actually have seen, unfortunately, reversed these positive pension reforms. So now we still face this problem in many member states. And okay, so this was to talk about the long-term sustainability that we had already since a long time. We have focused on this aspect. And but following the euro area crisis, we noticed that we could have also liquidity problem in some member states, and we developed other indicators to focus on liquidity risks for the short term, but also solvency risk, not only for the long term, but also for the medium term. In particular, what is called as zero indicator for the short term, that is based on the risk arising from some indicators related to macroeconomic and fiscal variables. But it's especially for the medium term now that we carry out a very developed debt sustainability analysis with deterministic but also stochastic analysis with many aspect sensitivity analysis, different development projection with different development in interest rates, but not only really many variables, many shocks. So for the next 5 and 10 years, we carry out this sustainability analysis. And we also have other indicators that are related to the threshold, that ratio in member states should be sufficiently diminishing towards 60% of GDP. So what we call the S1 indicator measure, which is the adjustment that should be done to reach that threshold in the medium term. And while for the long term, we looked more at the stabilization of the debt ratio with the expertly called S2 indicator. But it's so this is to focus on the time dimension, but then let's see many other factors that are taken into account in addition, I mean, to the classical interest and growth development and population development. In particular, contingent liabilities was always monitored, guarantees and risk in the banking sector. And then a number of other risks, but of course, and we take into account the debt profile, but this is quite, in terms of maturity, but this is quite normal, let's say. But what I wanted to stress is that now climate change, as you know well, is affecting the economy, and we are thus incorporating this risk in our projection and assessment. So now, it's very complex and detailed analysis, so it will take too much time to explain all the detail concerning our debt sustainability analysis, but you are very welcome to contact us if you want more detail. We have publication which you could see. And but let's move to the most recent economic development that are changing the context in which our framework is working, fiscal framework is working. First, of course, inflation development. You can see from the slide that inflation differs slightly across member states, but these are actually the spring projection forecasts. So now in reality the situation sees higher, even higher inflation rates, and they are very high for the standards of the last years, when we actually were closer to the risk of deflation. So other slide, going down. So beyond this, it's now it's of course accompanying inflation development, interest rates development, where now we see that all this discussion about the development of growth versus interest rate, that growth was always higher interest rates, and so there was a snowball effect leading the debt ratio to decline. In reality, now we are seeing interest rate increasing, so it's true that there's still a high inflation, so the real rates are different, but still it's a source of concern, this significant increase in the interest rate, something that needs to be monitored, especially because some member states, as you see in this graph, thinking of my own country, Italy, but also France, Belgium, Spain, and Portugal, apart from Greece, which is a case a bit specific. So they have high debt to GDP ratio, and the debt burden with this development in interest rate would become particularly heavy. So this graph actually want to show you that the situation of member states, as I mentioned before, is quite different. So some have high debt to GDP ratio, while others have public finances in a much better shape. And our fiscal framework has a difficulty that has to cater for all these different circumstances. So the fiscal framework, let's say, was quite effective for a number of member states in keeping public debt in check, while for others, the debt ratio remained quite high. There was not much correction. So this is an issue that now we are trying to solve with the reform of the fiscal framework, and that is ongoing. The reflection on the reform is ongoing, but in October we should come out with some orientations. The context, as mentioned before, is very difficult because we were exiting, let's say, from the problems economic crisis linked to the COVID-19 pandemic. Growth was really going well, rebounding significantly. The recovery was going well, but then the unprovoked and unjustified military aggression of Russia against Ukraine created again a difficult background, let's say, where Europe faces many uncertainties. There's a need to support the people suffering, the Ukrainian people suffering. There's a need for Europe to increase defense expenditure. And significant, of course, what is more evident now is inflation with significant higher prices for energy, which is creating some social problems. And so Europe will have to invest in for energy independence and to avoid the supply disruption in the future. And so in particular, we need to invest. This was evident already before these events, that public investment in Europe had declined too much in the European Union. And now it's one of our major objectives, in particular because of the green transition, which is really a big, for which the European Union is doing big efforts. We will have to invest a lot in following the COVID-19 crisis. There was an agreement among European Union member states to give money, grants, but also loans, but many grants, to member states that have been more hit by the crisis, to help the recovery, but also future growth in general, enhancing growth potential, through investment and reform, because especially the needs of investment are very high. And of course, this tool, the Recovery and Resilience Facility, is being implemented now, but it's a temporary tool, and the amount of the money is so high is not enough, and the private investment are especially will need to be very high. That's so now just this brief indication of the problem, many problems that we are facing as a policy. Let's see the policy implications. So in spring, the European Union issued recommendation for its member state concerning fiscal policy in 2023 and beyond. So the situation was already difficult. The war, the Russian war against Ukraine had already started, but in this context, it was considered that the uncertainty was such that fiscal policy should remain agile, but also diversified, because you have seen that the debt ratio are quite different across member states. Anyway, despite the situation, we are facing now a supply side shock, so there's no real need or possibility to intervene to foster growth through a broad-based fiscal inputs that does not appear warranted in this moment, while there are concerns for fiscal sustainability. So even the measures that will be needed to help the vulnerable household and enterprise that are facing this very high increase in energy prices and inflation in general should be measured by kind of redistributive measures that should be temporary and targeted, so that they could be reversed in future. So not broad-based fiscal measure, but targeted fiscal measure. As I mentioned before, again, we issue also regularly every year recommendations that are more of a fiscal structural nature. For many countries, it's requested that they approve pension reforms, other healthcare reforms, especially long-term care. You can see from the list that there are many member states for which suggestions are given to improve the taxation system, normally to reduce taxation on labor, remove it through other kind of revenue sources, taxation, different items, not the labor, but and then, of course, there is a need in some countries, maybe more than those, to increase, maybe more than those listed here, to increase expenditure efficiency through also reform of the public administration. I mentioned also the economic governance review that is ongoing because there is a need to keep that ratio under control, but there is high recognition that this would need also to ensure that the denominator, meaning the GDP growth, is not negatively affected by fiscal consolidation. For this reason, that's the action in the debt ratio should be gradual, maybe more gradual than envisaged by the current framework. And there was also consensus that, especially with all this uncertainty, necessity to take into account the need of more investment and more reform, the orientation of fiscal policy, our surveillance should not go here by here as it's now, but focus more on a medium-term horizon to give more elasticity over a medium term, but instead of focusing on annual adjustment, very specific, as very detailed as it's now. So this is, I said that we will issue our orientation in this respect in October. So we are meaning at the end, towards the end, maybe of October. Let's see. I cannot say much at this stage as us, but there is indeed a research of consensus among the member states to give more ownership to member states in the design of their fiscal policies, other than having very rigid and complex rules as what we have now. So my presentation has come to an end. I'm sure, that you would have also many advices to give to us, and sure that your discussion will highlight best practice and many recommendation and reflection on the policy to adopt. That's why I will listen carefully, and I invite you to contact us if you would like to share your experiences that will be useful for us and hopefully for you too. Thank you very much again, and goodbye.